Welcome. Today we're going to be talking about buying property in a company or in your own name. Hi, I'm Kimberly Shapcott, qualified chartered accountant with over 15 years of experience and a property investor with 6 properties and more to come. So you're thinking of buying a property. How are you going to buy that property starts to become the first question that most people ask. Should I be buying in a limited company or should I be buying it in my own name? So the big question I get asked a lot, when I have a company, how do I get my money out and what are the tax implications? Now, when you have a company, you will pay the corporation tax on the profits that are made in the company. So with this type of company, you'll get your rental income, you'll have your expenses, you've got your profits, you pay your tax, and that leaves us with X amount of money that can then be distributed or paid out to its shareholders. But that part is a choice, which means if you are already paying lots of tax and earning lots of money in your own name, you may decide you don't want to take any money out. That's not a problem. The reason that we have a company is to give us this choice. If you do want to take it out, you've got the benefit, if you've not got any other dividend income, that we have a 2,000 allowance at 0%. So whatever you're earning, whether you're a 40% or 45% taxpayer, you can still take £2,000 out of your company every tax year at 0%. So not a lot, maybe, but a little something to get the benefit of the property investments that you have made. Now, you might say, I want some more out. I don't want just 2,000. I actually want 5 or 10 or 20, whatever there may be in the company to actually enjoy the fruits of your labour. Not a problem. How you take these out of the company is via dividends. Now, dividends are taxed at the investment tax rates, which means it's not 20% when you're a basic rate taxpayer, it's actually 7.5%. And when you go up to being a high rate taxpayer, it's not 40%, it's 32.5% instead. So as you can see, getting the money out of the company, you are paying slightly lower taxes. So there is quite a bit of benefit there. And it works very, very well, especially if you're a basic rate taxpayer, because the tax rates are so advantageous at the 7.5%. The key thing to mention here is that the company has to be making a profit. So if you've not made a profit, and there are many reasons you may not have made a profit, one of the key ones that I find quite regularly is through property training costs. You may not have profits to actually take any dividends out of the company. Now, dividends can only be paid to shareholders, so you need to be a shareholder of that company to be able to take the dividend. I'll be doing a separate video on how to set up your shareholders and shareholdings so that you've got an idea of how to make it work for you and your family. The final element of this is where you go, but I would need to take some money out of my company and you've just told me I can't take a dividend. How do I take some money out? Well, if you've had to invest money into your company, for example, the deposit, you have loaned your company some money, and that would normally sit on your loan account, whether it be a shareholder loan account or a director's loan account, which therefore means if you're owed money from the company, you can repay yourself with no tax implications whatsoever. So yes, you can potentially take some money out of your company from loan repayments, and as soon as you become profitable, you can take money out as a dividend. If you have any property, tax or accounts questions, please do put them in the comments below and we'll answer them in the next future videos. Click like and subscribe to the channel to find out more about property, tax and accountancy topics. Share your video with your friends and anyone you think may find it useful, and let's make tax less taxing together.